Yeah, so thank you for everyone joining us. We just have a formality, disclosures. We have to let you know that we are a registered investment advisory firm here at Renewed Family Wealth. Some of the investments that we discuss will not be suitable for everybody. They're not insured or guaranteed, and past performance is not indicative of future results. So thank you for joining us today. Again, we are Renewed Family Wealth. I'm Scott Miller.
And I'm Michael Kohler.
And we're a registered investment advisory firm in West Palm Beach, Florida. We partner with individuals and families to guide them to be good stewards of their resources and make sense of the current markets and maneuvering through them based on their current circumstances and what's happening in the current market. I'd like to introduce a special guest, Josh Nicholas. He'll be joining us today on this call. Josh?
Josh, can you hear us? It's like Josh is still muted.
Well, let's get started.
Yeah, we'll catch up with him in a little bit.
Michael, current market conditions, what's going on?
All right, Scott. Well, I kind of like to start at the beginning. And February 19th really marks the date that the end, really, of the longest bull market we've ever had. And since then, there's been a ton of volatility, and I think March 2nd really solidifies when that started to get really heavy. It seems like since then, we've kind of had 1,000-point swings every day. And really, obviously, the pandemic has something to do with that. And I don't think it's the main reason why we saw such crazy volatility. And, what do you have to say about that, Scott?
I was reading an article regarding option expiration at the end of February, and just wondering what was happening. Markets were all-time highs, and then the following week, I'm reading this article, and it's talking about how traders in the industry typically say, don't let the retail investors see you sweat. And they were sweating. They were trying to keep markets at all-time highs so they wouldn't have to make good on exercising options where they would have lost billions of dollars. And once option expiration came to pass, they let the market unwind. And what ensued was a lot of short-term trading and shorting the market by institutions. And let's face it, the retail investor was along for the ride.
Absolutely. And that really brings us to today, where we saw stocks fall after new economic data showed us that U.S. retail sales and manufacturing output each declined by larger than expected margins this month. So as we continue to go through this, we do have some positive news that we'd like to look at.
Yeah, I mean, this has really brought us into the fastest bull market. It brought us to an end of the longest bull market in history, 10 years, and brought us into the fastest bear market in history, where we didn't see this coming. I mean, valuations were high, but things were good in the economy. We had no idea that the major impact, not only of the market just changing its valuations, but also this coronavirus having such a great impact. We didn't know what it would end up causing for the overall market conditions. But there are some bright spots out there. Like, we've been cooped up in our homes, right? So all this financial stimulus that we're getting from the government eventually will have to be put to use, right? This is pent-up demand. You and I can't wait to get out of our houses to seek some sort of normalization, to get back into the stores, to go out and have recreation activities, meet in various types of groups and locations, go back to the mall. Demand is pent up, so we're looking forward to a positive result in all this, that there will be spending in the long term. We have lower interest rates. The Fed has lowered interest rates to all-time lows, which for you and me, what does that mean? We can go out and buy a new car once we can leave our homes at 0% interest rates for for 72 months. We can buy a home at extremely low mortgage rates, right? We can buy large ticket items at very low interest rates to finance over long periods of time. Business loans are now readily available through the government. If you own a small business, you're getting some relief in this area. Not only are you getting loans, but you also were getting grants. I mean, this is good for the economy, I think, in the long term. Small companies can refinance debt at lower rates. The stimulus check that's coming in the mail through the CARES Act, and as well as other things like through unemployment. There's some benefits in that area as well. The Pandemic Unemployment Assistance Fund is now giving those who are filing for unemployment an additional $600 on top of the normal unemployment check that they would get. And valuations, I mean, this is really the big topic. As markets sought highs at the end of February, valuations have normalized. That we just got the opportunity to buy so many stocks, so many investments at a discount. I really see these things as positive incentives in the overall market, but also the economy at this time.
Yeah, I think valuations, and to put it into layman's term, I like to use this example, is I'm a big fan of chips and salsa. And when I go to the grocery store, I realize the secret to really good chips and salsa is in the tomatoes. So I'll pay a little bit of a premium on those tomatoes to make my salsa a little better. I like the heirloom tomatoes, if you want to know my secret. And even though I'm willing to pay a premium on those tomatoes, there'd be a certain price that tomato could get to before I'm willing to buy it. So if I go to the supermarket and that tomato is a $50 tomato, well, I'm probably going to sacrifice and say buy the vine ripe tomatoes or the Roma tomatoes. We can see the same thing in the market, especially looking back to January, where we have some great companies, Microsoft, Amazon, Google, all companies that I like, I use their products every single day, but at the valuations they were trading at, I just didn't feel comfortable buying those companies. Now, whether I already owned it or not is a different story, but have we gotten Josh connected yet? Josh, you there?
I am. Thanks for talking about that, Mike, about valuation. So valuation has been a key component of conversation in the market for the last 12 to 15 years, as we've continued to see margin expansion both on the earnings side, but most of the valuations that we've seen from the stock price have been outpacing the valuation and the margin expansion that we've seen from an earnings perspective. That all being said, it led to the valuations being a little bit too high, as you pointed out to. The only thing that I would say that is a little bit contrary to that is the long-term trend historically, and this is going back to 1881 when the Dow Jones Industrial Average first began, was that every single year, the valuation of the price to earnings multiple is what we're talking about, tends to expand by anywhere between 5 and 7 basis points every single year, or about 0.05 to 0.07 per year. And what that means is over time, people, and this trend has been around for over 100 years, have been willing to pay a little bit more. And part of the reason for that is because now we have, companies are reevaluating the dexterity of how they view their company's performance. Historically, we've seen a hyper focus on the next earnings over the next 90 to 120 to 365 days. But some of these technology disruptive companies such as Amazon, they pretty much say, or at least they said over the last 20 years, that we're going to eliminate the idea of having budgetary control, and we're going to invest every penny that we can into the market. And as a result, we're going to then drive our value of our share price as opposed to Wall Street. So I would say that valuations, although they were seemingly at least nominally expensive, it does appear that right now it's a very attractive time to buy, also given the long-term trend, because clearly there's a significant divergence.
Yeah, and as we partner with those that we assist with their finances, we have some really great opportunities on the table to make some good, sound investment choices in this current environment.
Yeah, and briefly, I'd just like to touch on the stimulus package, just because I know there are a lot of questions regarding it. There's a lot of intricacies to this plan, And a lot of you might have questions, and while we can't dive into every single, this isn't a presentation on the stimulus package, we're more than willing to answer those questions, especially if you're already retired and you have questions about your RMDs. There's some things that are changing.
Yeah, this is something that we've really pushed forward on, consulting those who we partner with and those who just really need our guidance in these current conditions to give information and help individuals maneuver through the stimulus that's in front of us.
Absolutely.
It could be overwhelming, and we want to help people make sense of it all.
Yeah, and it really has been amazing how quickly we've really learned how to operate the country from home. And if we didn't have the technology we did today, we couldn't be on this Zoom call. We couldn't be working from home. And so there's a lot of people are adapting to this, and I think people are getting used to life inside the quarantine. Unfortunately, there are some concerns and some people that, some jobs really that can't survive. So.
Yeah, and that's an unfortunate consequence of what we're experiencing here. This is an unknown because we've really never been in this type of situation before. Quarantine, people staying at home. But initially, our concerns, not only for people who are getting sick and dying, but how the overall economy would be impacted. And when we first heard rumblings of this in China, the major concern was the Chinese economy and their ability to get materials for goods and services to the end user, the consumer, through their supply chain, right? We put so much emphasis in having a trade relationship with China. Before Corona, we had really the trade talks. That was like the highlight, and that caused markets to sell off or to rebound based on whatever direction those trade conversations were going. So because we have so much invested in China and their supply chain and routes here in the United States, this is a concern for us. If we aren't able to produce goods and services to deliver to the end consumer, that slows down the economy, could even shut down the economy. We now understand that we have to look at new supply chains and delivery ways to deliver materials for the end consumer, but right now we're in the thick of it. Expectations of economic slowdown. What does it look like 1, 2, 3, 5 quarters from now? We have no idea, right? We do know that we have money in our pockets, but it's hard to spend it right now. And one thing that I read today was about credit reserves. Those out there, you may not know what credit reserves are, but Wells Fargo and Morgan Stanley, they have these credit reserves to spend based on operating revenues and current income when counterparties, those who have taken out loans against them or have bonds or derivatives, they start to default. So we're starting to see a crack in that area as well. What is the long-term impact of this? We're not sure yet. Disclosures, which we had discussed already, your local restaurants, your local gym, they're shut down. The shopping mall shut down. Nobody's out and about. But what does that look like? How does that impact the economy? Which, if the business is shut down, then nobody's working. And, we're happy that there is a $2.2 trillion stimulus package that we're able to benefit from. Some of those who are on this call may have already gotten their checks from the government as part of that stimulus package. If you have direct deposit on your tax return, some of you may already see the money in your account. But, is that going to be enough to ramp up the economy next quarter or the quarter after? We don't know. Think about large ticket items like housing, the housing market, right? The housing market was hot, for lack of a better word. And, my realtor, there's a realtor across the street from us who's coming to show homes on a virtual tour, like literally has their cell phone out showing people homes. Really creative and innovative, but people aren't walking through the homes at this time. Does the housing market slow down? Is that another area of the economy that's impacted by this? We won't know. We won't know right away, but we want to make sure that people are invested appropriately based on these concerns.
Yeah, absolutely. And we know that the stimulus package has shoveled some money into the economy. And Josh, would you like to shed some light on how that affects GDP and what to expect moving forward?
Sure. So it depends on how you look at it. Much like our analysis has been dynamic, so is the market and the reaction that we're seeing. Even just a week ago, it seemed like 2.2 trillion would have been enough to kettle the throw on the fire to keep it going. But I think that given in light of what we've seen over just the last week, I don't think it's going to be enough. So in a $19 trillion economy, 2 trillion buys us about 6.5 weeks worth of absolutely zero production. In a 70% consumer-driven economy, if right now we're looking at an unemployment rate, after we're going to get the number tomorrow morning at 8:30. But we just had 17 million people file for unemployment, which is initial jobless claims, in 3 weeks. 17 million. It's never been even close to that. There's about 130 million Americans working, and we were at 3.7%. So we're north of 20% unemployment right now, and that number is actually artificially changed because we've actually seen an increase in labor force participation. So I'm not sure if that's going to have enough to think that everything is going to be fine, at least over the short term. It's definitely going to be a longer term recovery. But from a GDP perspective, it looks like it's buying us about 6 weeks is what it looked like about a week ago. But now it looks like it's only going to buy us about 4, maybe 4.5 weeks, because we're starting to see a trickling down effect. Even the data that we got this morning in housing, and also companies right now are ripping their guidance. It just all it does is it points to a period of a lot of uncertainty, and so it's going to be very difficult to kind of forecast these types of things because there's just so many variables at this point in time.
Yeah, thank you, Josh. Really good points there, and a little scary to have that uncertainty. I think the market hates uncertainty more than anything, and as a result, the question I've been getting a lot lately is, should I sell all my stock? Scott, do you get this question at all?
Unfortunately, yes. And it leads me to believe a number of things. But first, fear and panic is not an investment strategy, so we would never advise anybody to wholesale fire their advisor and sell everything. It just doesn't make any sense. The first thing you want to do is take a look at how you're invested, equity or stocks versus fixed income or bonds. Do you have the right mix? Unfortunately, we've had the longest bull run in history, and people got bold. Let's face it. When I sat down with people to do a risk assessment, which is really the first thing you should do before starting an investment strategy with an advisor, or even if you were doing on your own, let's face it, I was more confident when I answered those questions 2 months ago than I would be today. And people have over-assessed their risk tolerance, meaning they felt more comfortable in riskier investments than really, when it came down to it, like these market conditions today, this came upon us in a blink of an eye, then I would have been able, or those of you out there would have been able to sustain in a recessionary period. And what has happened is you end up with the improper allocation. You have exposure to more equity or stocks versus bonds or fixed income. And what happens is you bear the full brunt of the equity sell-off when these things happen. So if you were to sit down with your advisor initially and have let's say a moderate portfolio, about 60% of your assets in equities or stocks and 40% in fixed income bonds and cash, because people didn't rebalance their accounts or limited rebalancing of their accounts because they just wanted more and more growth in their portfolio, what ended up happening is your mix got shifted. If you didn't rebalance as the equity market grew, you could have found yourself in a position from a moderate allocation with a moderate risk tolerance, your ability to stomach market volatility, to an aggressive portfolio where it would have been way too much risk. And when you see a recessionary period, and all this, though this recessionary period came on like a firestorm, came on so fast you really couldn't maneuver around it, historically, these types of recessionary periods like we've seen over the last month take a year plus to have these types of losses. And if you were invested inappropriately in an aggressive allocation because you let your equities grow and didn't take profits and rebalance to the other areas of the market like fixed income and bonds and cash, you definitely bared the full brunt of this recessionary cycle. And unfortunately, that causes the greatest amount of damage in your portfolio. So if you're on this call now and you're saying to yourself, wow, this is what happened to me, we would welcome the opportunity to have a conversation with you on how you can rebalance and get back to the right position for your own particular circumstances.
Yeah, absolutely. And I think that's one of the main benefits of financial planning as a whole is you're able to look at the big picture, what you're looking towards, what financial goals you're looking towards in the next 5, 10, 15 years. And, we were talking about technology earlier. Technology has gotten far in advance with financial planning as well, to the point where, we can run scenarios where we're going through an economic downturn like we are right now and still feel comfortable at the end of the day that it's not going to change my goals and I'm still going to be okay. And I think that piece is more valuable than anything.
True, very true. We just took a look at the macro outlook of all this, the big picture. What we'd like to do is look at the micro. How do we go about selecting investments that could do well in these current market conditions, that can maneuver through the downturn? And we'd like to ask Josh to just share some information about what we shared at our investment committee meeting a couple of weeks ago and how to identify securities.
Sure. So a couple weeks ago, well, actually, no, it's about a month or so ago, Scott came to me with an idea in the midst of this significant volatility, which was just to put it in perspective. Scott, you touched on it a little bit earlier, but typically it takes 151 trading days historically for a market to fall 20%. And we saw the market fall by more than 35% in 19 days. So that just kind of shows you how quickly the market has sold off. And as a result, we want to make sure that we're going to be invested in companies where price discovery in the stock market is not going to be indicative of an economic or the business's underlying economic condition. So what we went to do is we sought out based on theory in finance that basically derives its its thesis on the notion that organizations that have solid balance sheet structure and solid revenue growth are going to be the companies that historically outperform the market. And what we did is we went ahead and looked at we looked at a couple, but we just outlined 4 here and compared them to some household names. So one of the stocks that we added in our pretty much defensive portfolio was a First Pawn, which is a pawn shop stock. And we looked at these 4 ratios: current ratio, debt to equity, payout, and revenue. And basically what each of those numbers mean, just high level, current ratio means that if the number is 1 or greater, the company has sufficient cash and capital to cover all of its immediate expenses for the next 12 months or more. And clearly you can see the company that we chose to put in our portfolio is much more liquid than other household names. Disney and Apple, by comparison, would not last as long as a pawn shop, of all things. Who would have thought? The other thing is debt to equity. As one of the downsides of where there's always a positive and negative, but if interest rates go down, that's good for people who are borrowing money, but it's bad for people who are lending money. So organizations like banks, credit unions, typically who fund and provide financing, bridge loans, commercial paper, things like that for these organizations, if interest rates are so low, they're going to tighten the requirements because they just don't want to take unnecessary risk. And so as a result, companies that already have a ton of debt, such as companies like Apple, they're going to find a much more difficult time to find financing than other organizations that have much more solid balance sheets. And then payout ratio was something we looked at as well to make sure that a company is rewarding its shareholders. But at the same time, we wanted to make sure that ratio was in a moderate percentage, just because one of the things that that management can do of an organization is artificially pay out a significant portion of the earnings in order to prop up the stock price based on the dividend yield. And then if that's the case, and these are usually symptoms of a pump and dump kind of scheme, and we want to avoid those type of organizations. And then finally, we want to have companies that are having moderate growth. We're not looking for things that have double and triple digit growth. These are long-term plays that we want to, that where our key focus was sustainability. And so I think that this was just one example of one of those stocks that fit the criteria. And it's interesting because there's more than 5,000 stocks traded in the market. And of those 5,000 stocks, based on the metrics that we looked at, only 138 of those stocks actually met the criteria. And then we continued to narrow that group from 138 all the way down to 24. And well, now it's 23. But that's really the ultimate outcome. And the numbers spoke for themselves whenever we looked and back tested the data over the last 10 years plus. And it was just really astonishing.
Yeah, thank you, Josh. This is just one of the things that we're doing here at Renew Family Wealth to make sure that those who are seeking us for guidance in these circumstances end up on just a favorable side in knowing what they're doing, right? Getting good sound advice from us and being able to have an investment strategy that can assist them in maneuvering through what we all know are really volatile market conditions. It's really easy to make money when the market's doing well, right?
Yeah.
Right. Talk to us a couple months ago. It was a much different conversation. But how are we going to be innovative and develop investment strategies that can assist those that partner with us to be successful in not only the short term but in the long term? We really thank everyone for being on this call right now, and we know you all have additional questions, so we'd like to follow up with you. We do have your contact information because you did register with us, and we'd like to schedule some time to speak with you one-on-one regarding your own individual situation. That way we can customize a plan that's appropriate for your specific circumstances. Again, we just thank you for listening to this webinar. We love this technology. We plan to do more in the future, and we welcome the opportunity to invite you, your family, your friends, and associates to join us for some more valuable information as we get more and more updates about what's happening in the overall economy. We're here to help you. You're important to us. You matter to us, and we look forward to partnering with you in the future.
Yep, and also if you wanted to stay up to date with what's going on with Renew Family Wealth, you can visit us on renewfamily.com. In the updates tab, we have a lot of communications that we put out on a regular basis. Feel free to read past and future updates there. You can also follow us on LinkedIn, Facebook, and YouTube. Or if you have any questions that you don't want to call us, but you just want to shoot us an email if it's on your mind right now, feel free to contact us at info@renewfamily.com, and someone will get back to you within 24 hours.
Yes, so on behalf of me, Scott Miller,
And Michael Kohler.
Josh, we know you're there.
Uh-huh.
Josh Nicholas, Hayden Dawes, and Robert Christie, we thank you for joining us, and be well, be safe, and have a good evening.
Thank you.